Thank you for watching this video. I'm Tomoya Maruoka, CEO of ENECHANGE. Here's the executive summary of the FY2024Q3 earnings results. There are three key points. First, the 100 days transformation plan is progressing smoothly. Notably, we had a very important progress in the resolution of the impairment in the EV charging business. This issue, which we identified as a top priority under the new management structure in the last earnings call, has been resolved from Q3. Resolving it from Q3 was the earliest possible time. I'm proud of the team realizing it at the earliest opportunity, and there are other key progresses which we will deep dive on later. Second point is that the high growth in the platform and data business continues in FYQ3, and there was a steady progress in the EV charging business. Finally, we are maintaining the guidance announced on September 13th and aim for the profitability in FY25. So first, we'll deep dive on the ENECHANGE 2.0 100-day plan. This page is a recap of the three phases of ENECHANGE 2.0, which we announced on September 13th. We are currently in the middle of the 100-day plan. The 100-day transformation plan for ENECHANGE 2.0 is progressing. The key progress is mapped around our strategy house. As you can see, there are four main progresses, which we will deep dive from now. The first point is the smooth progress in EV charging business. On September 30th, we signed a bridge loan agreement which enables us to manage the working capital for the necessary constructions for the EV charging installation. We are pleased to tell that the constructions are progressing smoothly and expecting to complete an additional 3,000 to 3,200 installations by the end of November. With these new installations, the total number of ports is expected to reach between 5,500 and 5,800 by the end of November. The pace is anticipated to remain steady, and we expect the number of the port will be over 7,000 by the end of January 2025. There is another important news. We have strengthened roaming partnership to improve the customer experience. Since 2023, we have partnered with e-mobility power for roaming services. Additionally, this time, we are planning to start a new roaming partner with Toyota Wallet, a payment service provided by Toyota Financial Service. The detail will be published on November 18th. We will continue to work on the improvement of customer convenience. Next point is the resolution of the impairment losses of the EV charging business. This could be the most important update in this earnings call. Under the management team, we identify the impairment losses of the EV charging business as the highest priority to solve, and we successfully resolved this issue starting from FY2024Q3. The key measures to solve this issue were three things. First, securing a bridge loan on September 30th, and second, the transition to a new management structure which contributes to improving the credibility from financial institutions, and third, that improving the future perspective on the profitability of EV charging business, including the cost reduction initiatives. With the resolution of the impairment losses, EV charging assets will now be capitalized as fixed assets from FY2024Q3 as per the right diagram. As for the assets that is capitalized from January to March, based on the receipt of the subsidy, we will recognize a loss on the reduction of the fixed assets. The third update is strengthening financial foundation. As you can see in the chart, the net assets were reduced from 800 million to 100 million at the end of September, because that the EV charging business recorded an operating loss due to upfront cost for business expansion. Going forward, with the subsidy inflow, the net assets are expected to improve by the end of March 2025. As we discussed earlier, we will recognize a loss on the asset reduction based on the receipt of the subsidy, but the assets for which we previously recognized impairment loss will not require an asset reduction loss. Hence, we expect to have a substantial amount of non-operating profit in Q5, which contributes to improving net assets. Additionally, we are actively working on the options to strengthen the financial base, not only to meet the March 2025 listing criteria, but also to support the balance sheet for future growth strategies. Once we have more complete information, we will disclose it. The fourth point is the preventing measures. Based on the measures we released on July 29, we are proceeding as planned. We developed 3 main buckets of initiatives. As you can see under the column, status column, many initiatives are either finished or operations begin. The remaining initiatives have a blue color showing ongoing. We will ensure these initiatives will be progressed as per the original schedule. These were the 4 main updates in the 100-day plan for this earnings announcement. We are committed to steadily implementing the 100-day plan and moving forward to the next phase of ENECHANGE 2.0. As for the future communications, we plan to release the second growth potential report as a summary of 100-day plan between late January and mid-February. Next, we'll look at the financial result for the FY2024Q3. The total revenue and recurring revenue of the platform and data businesses, which we categorize as a core business, continue to grow at more than 20% year-on-year, achieving a record high cumulative total revenue for Q3. The underlying KPIs for 3 segments also show strong performance. In platform, we see a steady growth of number of users from the 627,000 last quarter to 650,000 at the end of Q3. ARPU for recurring revenue reached the 700 yen range, reflecting the summer electricity consumption. In data business, recurring ARPU, which is the most important KPI for this business, improved 34% year-on-year. In EV charging business, at the end of September, 2,500 ports were installed, but as mentioned earlier, this number is expected to increase to 5,000 to 5,500 by the end of November, and to over 7,000 by the end of January. The strong performance of platform and data business reflects in their revenue and recurring revenue growth, as we discussed. The combined operating profit for these 2 segments increased to 14.6% year-on-year, reaching 430 million yen. However, the EV charging business recorded an operating loss due to the upfront cost for the business expansion. Hence, the total operating loss was 2 billion yen. Next, we look at the future outlook. We are maintaining the old outlook disclosed on September 13th, although we expect a temporary profitability for FY2024Q5 the total 15-month FY24 is forecasted to remain in deficit. However, we aim to achieve profitability in FY25 as we disclosed last earnings call. As for the progress towards 12-month revenue target, cumulative Q3 revenue has reached 80% of the 12-month forecast, indicating the steady progress ahead of schedule. From here, we'll deep dive on the detail of each business. The first, platform business. The revenue in platform business for Q3 was 972 million yen, and operating profit was 136 million yen, both of which have improved year-on-year. Regarding Q3 revenue, it appears to have decreased compared to Q2, but this is due to the impact of the seasonality. Specifically, Q1 is normally the peak of sales due to the busiest period for moving and changing electricity contract, and some of that revenue shifted into Q2. Therefore, when we compare Q2 and Q3, it may seem like the growth has been slowed down. The number of users grew at 21% year-on-year and reached to the 650,000. The recurring revenue ARPU is also approaching close to the all-time high due to the impact of the rising electricity cost and seasonality. If we look at the business environment, as we discussed in the previous earnings calls, the share of electricity sold by the new entrants reversed its trend in June 2023 and has been steadily growing since then and now reached to 18.4% share. The fact that the new entrants recovered their customer acquisition activities contributes to tailwind for our company. Hence, we expect to see steady growth in this business segment in coming quarters. Next is a data business. In data business, Q3 revenue reached to an all-time high, led by the growth in recurring ARPU, and the segment profit continued to remain steady. The recurring ARPU, which is the most important KPI for data, continues to perform well, supported by the upselling effects. For the coming quarters, we will continue to focus on upsell and cross-sell to improve the recurring ARPU in this business. Next is EV charging business. Since we consolidated the SPCs, the charging time is the most critical KPI for this business segment to check the health of the business. The average monthly charging time in Q3 reached to 19 hours, influenced by the summer vacation period, as well as the summer travel campaign conducted by us. We understand our charging time to be at the leading level in the industry. We continue to aim to lead the industry in terms of the charging time and customer convenience. If we look at the business environment for EV charging business, the sales ratio of new EVs in Japan still stays at 2.6%. However, as we discussed in the last earnings call, the importance of the level 2 charging, which we are focusing on, is expected to be higher in light of the increased importance of KEV and PHEV. As you can see in the right side of the chart, the 70% of the total EV sales in Japan is KEV and PHEV. Given the EV expansion in Japan, it would be led by these car segment with a smaller battery size, for example, 20 kilowatt hour. The importance of level 2 charging infrastructure is expected to be getting higher. Finally, regarding the future updates, we will continue to implement the 100-day transformation plan and aim to release the summary of 100-day plan and Q4 result by mid-February. We will continue to provide updates with high transparency going forward. Thank you for your support and watching this video.